Hey everyone, let's jump right into this explainer analyzing CTS Corporation's Q2 2026 results, which literally just dropped today, July 28th, 2026. Look, if you've been following the industrial and components sectors lately, you know it's a wildly tricky macroeconomic environment out there right now. We're navigating a landscape defined by persistent supply chain shifts, ongoing inflationary pressures on raw materials, and fluctuating interest rates that are causing a ton of hesitation in capital expenditures across, well, pretty much every industry. But today, against that rather challenging backdrop, we're going to unpack a truly fascinating narrative of strategic shifts, impressive resilience, and some seriously strong numbers from CTS. So grab a notepad, get comfortable, and let's see exactly how management steered the ship this quarter. Okay, let's dive into this top-line anchor number. CTS just reported $145 million in second quarter revenue. Now, to put that into perspective, in a market where a lot of companies in the manufacturing and component space are struggling just to stay flat or worse, are actually revising their annual guidance downward, CTS delivered a notable 7% year-over-year increase, along with a 4% sequential bump from Q1. This isn't just a minor beat, right? It's a really clear signal of solid execution across their global operations. But as we all know, a revenue number alone doesn't really tell us the whole story, particularly how profitable those top-line sales actually were.
And that brings us perfectly to their profitability metrics. This strong top-line growth, combined with an adjusted gross margin that expanded a massive 270 basis points to 41.5%, pushed their adjusted diluted earnings per share up to a rock-solid 74 cents. That is a 17-cent jump year over year. Management actually noted that this margin expansion was driven by a great combination of smooth operational execution, a highly favorable product mix favoring their higher margin segments, and, some foreign exchange benefits that provided a nice little tailwind. They're clearly converting that revenue growth straight to the bottom line and doing it efficiently.
Section 1. The Diversification Growth Engine. So to understand exactly how CTS got there, we have to look at the fact that diversified end markets have grown to command 59% of total Q2 revenue. This fundamentally changes the company's operational profile. Historically, if you think of CTS, you might immediately picture transportation and automotive components. But this 59 to 41% split, it shows a very deliberate and, frankly, very successful pivot. By not having all their eggs in the automotive basket, CTS has essentially insulated itself against sector-specific cyclical slowdowns and opened up entirely new avenues for sustained, long-term growth across some highly technical fields. This diversified segment is absolutely doing the heavy lifting right now, posting a robust 15% revenue growth year over year. And what's even more promising for the future is that they're maintaining a very healthy overall book-to-bill ratio of 1.17. Now, for those of you newer to tracking these specific manufacturing metrics, a ratio over 1.0 basically means a company is bringing in more new orders than they're currently shipping out and billing for. So this effectively builds a backlog of future revenue. It's a highly reliable leading indicator of sustained operational momentum in the quarters to come. Let's break that diversified segment down a bit further. Looking specifically at aerospace and defense, it's actually a really nuanced picture. While actual recorded sales took a little 15% dip, mostly just due to the simple, everyday timing of government and defense contract awards, the future pipeline looks incredibly bright. Bookings in this sector actually exploded by 48% compared to Q2 2025. They secured a book-to-bill ratio of 1.23 here, and crucially, they even added a brand new customer in defense satellite communication for their RF filter products. So they are actively laying the groundwork right now for some very significant future revenue realization. Which brings us to the fantastic momentum in their medical segment. This area surged 45% year over year to $28 million. It's literally a stair-step progression when you look at the data, from $19 million this time last year, up to $25 million in Q1, and now hitting $28 million in Q2. Management credits this to sustained demand for their therapeutic and diagnostic products, alongside incredibly tight partnerships with healthcare customers for next-generation product development. And in the medical field, when a component is designed directly into an FDA-approved medical device, that revenue stream tends to be highly sticky and exceptionally long-lasting. It's a real game changer. Capping off the diversified sector, the industrial market also showed fantastic strength. CTS is definitely not just a one-trick pony. They have solid momentum across a wildly diverse set of applications, particularly as industries lean heavier into things like automation, IoT integrations, and smart manufacturing. They brought in 2 brand new customers this quarter and boosted sales by 16% over Q2 2025.
With a book-to-bill ratio of 1.11 in this specific category, the industrial segment is proving to be a highly reliable, really steady contributor to that broader 59% diversified pie.
Section 2. Navigating the transportation market. Now, to build a complete picture, let's talk about transportation. While this segment did see a modest 2% revenue decline this quarter, the absolutely crucial point here is their massive safety net, a $1.2 billion total booked business backlog. Yes, the immediate quarterly revenue is slightly down, which directly reflects the broader, well-documented automotive market realities and shifting production schedules. But that $1.2 billion backlog, that represents a massive, multi-year pipeline of expected revenue derived from long-term agreements. It provides incredible forward visibility and just total stability to their financial modeling. And proving that their pipeline remains super robust, despite that slight revenue dip, they still secured $163 million in new quarter wins. Some of the key highlights include locking in a major sensor award with a North American original equipment manufacturer, which is a huge vote of confidence in their engineering. And even more important for tracking long-term macro trends, they successfully added a new electric vehicle customer. They are actively and successfully pivoting their legacy transportation expertise and adapting it to fit the rigorous demands of the global EV transition. Going forward, management is remaining highly pragmatic about this sector. They're setting very realistic expectations, projecting overall light vehicle production to be flat or slightly down in the near term as consumers react to interest rates and vehicle pricing. However, they did note that this softness in light vehicles should be partially offset by steadier commercial vehicle volumes, which tend to operate on totally different replacement cycles. Ultimately, it's a mature, realistic outlook that doesn't rely on sudden automotive market miracles, leaning heavily instead on that secured backlog. Section 3. Financial Health and Cash. So how does all this operational success translate into raw financial health? Well, CTS is operating from a position of profound stability. They're holding $108 million in cash on the balance sheet compared to just $55 million in borrowed debt. Think about that for a second. In an era where elevated borrowing costs and super tight credit markets have been a major headache for so many mid-cap manufacturers, having a net cash position of this magnitude gives CTS incredible operational freedom. They simply aren't beholden to massive interest payments eating away at their operational gains. And this strong balance sheet isn't just sitting there gathering dust. It's being put to work effectively. Year to date, they've generated $41 million in free cash flow. They've rewarded their investors by returning $15 million to shareholders through dividends and share repurchases. And perhaps most importantly for navigating such a fragmented industry, this war chest leaves them perfectly positioned for strategic mergers and acquisitions. If an attractive, complementary technology or company suddenly becomes available, CTS has the dry powder ready to act decisively, without over-leveraging themselves. Section 4. Future Outlook and Assumptions. Wrapping up our explainer, let's take a look at what's guiding CTS through the rest of 2026. Management is keeping a really close eye on some specific macroeconomic headwinds. We're talking about the ongoing unpredictability of geopolitical conflicts, the evolving nuances of trade pacts like the USMCA, potential new tariff changes that could completely disrupt supply chains, and of course, the ever-present threat of inflation in precious metals and petroleum-based products. To successfully navigate these threats, CTS is focusing heavily on maintaining agility in their cost structures and pricing actions. That strategic agility acts as their primary shield, allowing them to pass on costs or adjust operations swiftly to fiercely protect those expanded profit margins we talked about earlier. Which really leaves us with this final thought to ponder. As global trade dynamics continue to shift and the macro environment remains, well, entirely uncertain, will CTS's impressive diversification engine be enough to outpace all this macroeconomic friction? They've built a highly secure $1.2 billion safety net in transportation and ignited some truly substantial growth across medical, aerospace, and defense. But the ultimate test will be exactly how well their agile cost and pricing strategies hold up if these global pressures intensify. It's definitely going to be a fascinating story to track in the coming quarters.